Think a lot of real estate investors are being a bit cautious into where they want to put their money, whether they want to buy any more deals, right? I think the crackdown on immigration has been a little bit of a heartfelt situation for real estate because we depend on labor, right? And if that labor does not exist anymore, it's hard to finish the projects.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Ruben Izgelov, thank you so much for being here, man. I've been excited to talk to you for a bit now. I've seen you on the books. We've moved our scheduling a couple times now. I know you've been busy, and I super appreciate you making the time to be here. You've got quite a background. You have not only been doing investment. I saw that you went to law school as well, right? So you've
I
got
did.
this really cool background to things. And from founding partner and strategic advisor for WeLend, as well as co-founder and managing partner for States Capital. There's some really good things for us to talk about today. And today's episode, we're going to be talking about, of course, passive investing, talking about more about WeLend, the fund that you guys have, and advice of someone who's just starting out. But I also know that you've got quite a bit of experience, and I have some other questions maybe around asset allocation, where this fund and where investing kind of plays for not only newer investors, but as they think about their journey. So
Of course.
please hand this over to you. Give me a little bit about yourself, your background professionally, and anything else you want to drop in to introduce yourself.
Sure, Stephen. I really appreciate you taking the time. It's a pleasure to finally be here. I know we've been trying to put this together for some time, so it's finally here.
Hmm.
But nevertheless, I'm Ruben Izgelov, managing partner and co-founder of WeLend. We are essentially a private lender providing bridge capital for real estate operators and investors. But I wasn't a bridge provider and a lender for all my life. At some point, I was an immigrant that came to the U.S. at 6 years old. Went straight to the public education system, thinking that we're going to live this life, the American lifestyle, and take over the world. I went to the public education system, and eventually I ended up dropping out of high school, right?
Hmm.
Thinking that high school is just not for me. I can take over the business world and do well without an education. And long and behold, the great financial crisis hit, and I realized that money, the flow of income is not always consistent. It's not always guaranteed, but having an education will definitely help you kind of at least improve your odds, right?
Hmm.
So that's why I ended up going back and getting my GED and ultimately going to undergrad at St. John's here in Queens, New York, and ultimately going to law school and graduating top of my class in both undergrad and in law school. And while in law school, I get a call one day from a private lender conference. At that time, it was called the Pitbull Conference. Today, it's called the National Private Lenders Association, the NPLA. So, shout out to them. They're doing some amazing work when it comes down to the private lending industry. And I get a call from, at that time, the owner and operator. And he said, "Look, I see that you're a real estate operator." At that time, we were buying, selling, flipping, developing real estate. He said, "You need to come to this private lender conference to find a cheaper source of capital, cheaper source of hard money, because we see that you're active." So I said, "You know what? Before I start studying for the bar, might as well go out there and just kind of see, what it's about." I went in as a private investor and private developer. I walked out as a private lender. I've never looked back since.
Hmm.
Since then, we've originated about $700 million across about 1,400 loans nationwide. And we're very proud to say that we've never lost any principal, right? While
Nice.
deploying almost $1 billion, right? And the only reason why is because of the nature of the loans that we make, the nature of our investments, just a lot safer. It's a lot more consistent and persistent. And I think that being a lender over being a real estate operator is a lot more safer than anything else.
Awesome. That's there's some questions there along the way too, right? You know, that is an interesting shift from thinking, screw it, I'm gonna go out, I'm gonna, just hands on, take massive action right there,
Yeah,
right? And not needing the education to going back, getting the GED, and ultimately through law school. Not a short journey, right?
it's not.
So, um, And I'm just kind of curious. Don't need to spend too much time on that. But what was the shift there of, well, I need to get my education. I need to, get myself on track here. What was
My
that?
my late father, he was a very wise, quiet man, and, at that time, this was what, 2006, 7, 8 time, I was a loan originator at a mortgage brokerage shop in Long Island, New York, and I was making at that time, you could say the equivalent of about 300,000 a year, right, of
Mhm.
today's, currency. But, I went from making 300,000 a year to almost making maybe about 10,000 a year, right? Because the great financial crisis hit. So I was
Mm,
sitting depressed at the kitchen table, and my father approached me and said, "Look, son, you're okay. Obviously, I'll take care of the rent. I'll take care of your bills. I'll help you out as much as I can." I was a teenager at the time. He said, "But what's going to happen when you have a family? You have kids. You have a family to support. You have a wife that's demanding, right? What are you going to do then?" Not
mhm.
not to say my wife is demanding. My wife is different. She's very
Of
just in
course, of
case she's
course.
listening to this, right? But nevertheless, what are you gonna do then? That was his big question. And I said, "Look, pops, you know what? You have a very good point. You don't have to say anymore. I'm gonna go back to school, right?" And that was his kind of way of telling me, "Go back to school and get your education," just to kind of again improve and increase the odds of the future, right?
Right.
We look. I'm not a gambler, but I've been to Vegas, right? I'll do whatever I can to improve my odds,
Totally.
right? And that's on a $50 bet. What what
Mhm.
what what are we to say about our entire life and our children's life, right? Whatever we can do to improve the odds for them, we do.
Yeah. Yeah, there's a lot to be said there, right? About today's thinking about traditional school, et cetera. And it's less about that, but more about developing that skill and that asset that you are, right? Okay, so you along the way, you're learning to flip homes or you were flipping homes and you
Yep.
were being that operator, right? You were talking about this conference that you got the call for. Ruben, dude, you got to go check this out. You walked in, an operator came out, a private money lender. And I think this shift is such a powerful one. I've told you before we started recording, I get, conversations from my colleagues, investors like, hey, Arita, my last name, what should I go invest in? And they're thinking about doing their own flips and stuff like that. And then, inevitably the conversation is, hey man, you got to take inventory of what your skills are and how much time you want to dedicate. What were your shifts from operator to what made you a believer for private money lending?
So it's a very good question, actually, and I'm happy you asked because at the end of the day, what really attracted me to being a private lender is the fact that we're able to hit equity like returns, double digit teen returns, while being in the safest part of the capital stack. And the question then is really like, what does that mean, right? Like,
Hmm.
what does that actually mean, right?
Yeah.
And the answer is very simple. I mean, look, I think every single investor, what we're trying to the goal that we're trying to hit is to hit the highest and safest returns possible.
Yep.
Well, being a private lender enables you to do that, right? And that's just because of the nature of the investment. You're the last one into the deal, but you're the first one out. There's so much subordinate capital that sits ahead of you to in the event of any kind of market shifts. You're not the first one to lose money. There's a lot of equity like investors who are putting in their hard-earned dollars ahead of you that lose first in the event of any kind of market shift. And I think for me being, an attorney today, although I don't really practice on a day in day out basis, being an attorney, I always see the downside before I see the upside. And even some of my partners are always like, "You're
Totally.
such a pessimist. Stop looking at all the." And I'm like, "Look, law school kind of trains you to see all the downside before you see the upside." So I think, when I was in that at that conference, I heard that attorney speak. His name is John Hornick, great guy, by the way. I heard him speak, and I was like, look, clearly, being a lender is probably my calling for life, right? Because I'm a conservative guy. I don't like to take huge risks. I like to know that my money is safe. I like to know that my friends and family money is safe. And I like to be able to know what my returns are going to look like and that it be consistent. Being an equity player, being a real estate operator, it's not truly passive, right? A lot of people think that it is. It's not. I mean, I'm sure you understand this. You have, sometimes late night calls, you have tenants that are paying, sometimes not paying. I mean, I don't know who
Mhm.
wants to deal with that, but sometimes tenants are not paying, right? And you got to still fix all their stuff that's going wrong in the house. So I think, wanting to also have a passive income is really what attracted me along with all the other points to being a lender.
And that makes sense. I mean, there's some hurdles here, right? Like, that sounds good, but you need, in this case, I would say that adage of that, you have to have some money to make money. You have
Of course.
your
Yeah.
asset is your
Yeah.
money and you get
Yeah.
return on that asset,
Yeah.
right? And we'll talk about that in a second, but this is besides from going out and doing marketing or whatever to wholesale or flip or whatever, which is great if you have the time,
Yeah.
right?
It's good
Um,
money.
but I wanted to kind of ask the hard questions here, which is you absolutely can be getting it more passive, right? Make the money to, use your money to get money. But, what are your let's provide the transparency here because there is arguably you're going to make more money if you do something as an operator, like more actively versus passive, right? And so
Totally.
that has to
Totally.
be said. So tell me about like what someone should be thinking about for their own decision making, listener wise, if that's good for them or not.
So you hit it on the head, Stephen, and I think being a real estate operator, there's a lot more upside, right? There are deals when I was in the real estate space where I made over 100% of my money, right? Sometimes even 500% of my money in a very short period of time. So in debt, being a private, lender in the private credit space, while it's the golden era of private credit, in my opinion, um, you really can't hit 500% returns, right?
Mhm,
It's really hard to come by. So I think that, for those investors who are kind of sitting home and they have the ability to make a decision as to what they want to do, I think being a real estate, investor, being an equity player is probably the best route if you don't really have a full-time job, right? If you're not a doctor, an architect, an attorney who has a full-time day in, day out job, and you have the ability to actually work actively versus passively, then you
mhm,
should definitely probably look into, buying real estate, developing real estate, and operating your portfolio. But if you're an investor, if you're a person that has the liquidity, but you also have a full-time job that you tie down to, you can't really operate, in the real estate space as an equity player because you don't have the time. You have to continue with your full-time job. And I think today a lot of our investors, although some of them are actually also our borrowers because they know our underwriting is airtight, they are mostly architects. They're mostly dentists. They're doctors. They're attorneys. They're entrepreneurs. They're restaurateurs. I mean, they have full time jobs. And as a result, they can't really invest into real estate actively. They want to invest into real estate passively. And our WeLend fund enables them to do that.
yeah, and I know you hadn't mentioned it here, but I'll just state it here too that, tech professionals, especially like my colleagues at Amazon, the Netflix, the Google, I mean, this is the 40, 60 hours, type as well that are accredited investors. And if you don't know what accredited is, go check out one of my other episodes, go and Google it. I'm sure Ruben has some stuff
Or
on his
chat
site as
GPT it.
well. There you go. Thank you, sir. I appreciate you. Everyone listening is chuckling. But yeah, okay. So, and just to make this plainly and simple, when you're talking about equity investing, you just like a strategy or two just to call out like what that looks like, what that
Sure.
means.
Yeah. Yeah. So a lot of our clients, you can say, right, our borrowers, they're equity players, right? So what they're doing is they're buying the properties
Hmm.
and they're investing into it with their own hard-earned money. From time to time, they'll also bring on passive investors, right? These are also doctors, attorneys who don't really have the time to be able to manage the real estate. So they'll invest with another operator, a syndicator alongside that investor, and they do so passively. The only problem there is that a lot of our investors who are investing into our fund, they've been kind of shying away from that because investing into real estate, the cash flow is not instant, right? It takes time, right? By the time you buy the property, you reposition it, you rent it out, the whole nine, you lease it out. It takes time, right? So some
Hmm.
of our investors, they want instant cash flow. In addition to that, it's not really a liquid type of investment, right? Being an equity player investing into real estate directly of buying real estate, it's not a liquid investment, right? If you want to be able to pull out, sometimes you have to wait 3 to 5 years. And some investors don't have that, right? They don't have that flexibility. Sometimes they want to be able to invest into a product or investment for only a period of 12 months, right? And being a lender, being a private credit provider, your investments today, at least for us, our investments are the terms of our loans are only for a period of 12 months. So that means that if our investor wants to be able to pull out and redeem their investment, the lockup period is only 12 months. But most importantly, the cash flow is instant. Within 45 to 50 days of their investment, they start receiving direct deposits into their bank account.
Yeah. And so when you're saying private credit, you really are just using that as another term to be synonymous with a private money lender?
Lender. Exactly.
Okay.
Exactly. Yes.
Good.
Yes.
Just wanted to clarify that for the listener because the two different terms. And so you're talking about, let's say, the equity play is, someone that's going out and actually doing, the finding the properties, doing the analysis, doing the acquisitions, doing any value add or whatever needs to be done, and then making sure a tenant or someone in there to pay the bills to finally get that money versus something like what you're talking about, where you invest into something like your fund or fund in general to start getting, what did you say, something like 45 to 60 days later?
Yeah, 45 to 50 days they start receiving their distribution. So usually we accept investments between the 1st and the 10th of the month, and usually the following month between the 15th to the 20th, we start making distributions.
Okay, cool. So, what are they actually investing in? And I want to spend a little bit of time here and teeing us up for another big topic. So, let's talk about what they're actually investing in.
Yeah. So we manage a 506c Reg D. It's an exemption through the SEC. It's essentially a private, placement. It's a private debt fund. So they're investing into a fund. And that's actually another upside to why, investing into a fund has a lot more advantages than investing into one single deal or one single loan.
Mhm.
When you invest into a fund, your money is diversified and is diversified amongst a number of different asset classes, a number of different borrowers, and a number of different locations versus making one single loan to one single borrower. And we have some investors doing that as well. Well, now your money is concentrated into that one single deal, one single borrower, one single location, one single asset.
Mhm.
So tomorrow, if that borrower, for whatever reason, defaults, 100% of your money is now at default, right? Versus in a fund structure, your money is diversified amongst a number of different loans. So you're a lot more secured through the power of diversification. So to answer your question, and I always answer every question in a very long-winded way, so forgive me. But to answer your question, they are investing into a fund. It's a 506c private placement.
Super cool. And I actually really like the points that you hit too, because you talk about diversification, but you give the example versus sometimes the, colloquial traditional advice is diversify, diversify. But like, what does that mean?
Right.
Right. And you talked about different locations, right?
Yeah.
I think it's mostly East Coast for you guys, right?
Correct. So I would say the backyard for us is really New York.
Hmm.
That's where we're located. That's our backyard. So New York, New Jersey, Connecticut, Massachusetts, and kind of like the South corridor. So Florida, the Carolinas, sometimes even in Texas. We've made some loans in your backyard as well.
Super cool. And um, the asset you're providing, or sorry, the product you're providing from the fund is really funding projects,
Correct.
right? So, talk to me because tech professional, super analytical, as I'm sure you can appreciate, just like many doctors, lawyers, etc. Is where's the money going? Like the question
Yeah.
is, how do I get paid as the investor? How does the
Yeah.
fund get paid? But
Yeah.
it's like this why haven't I heard about this, Ruben? Right? What these
Yeah.
funds things, right? So, let alone syndications. It's like, how does this work?
Yeah.
So, where's the money go? Where does the money come from? How does the fund get paid? How does the investor get paid?
Yeah. So our money comes from accredited investors. And you mentioned it before. You can chat GPT it, Google it, what have you. So all of our investors are retail investors. We don't really have any institutional investors. We focus on retail investors, high net worth, ultra high net worth individuals who just want to, again, receive passive cash flow and do so on a consistent basis. They're really kind of, I would say, conservative investors that don't want to take high yielding, risk or high risk in general. So we raise money from friends and family and so on. The deals are going into real estate acquisitions, generally speaking, right? So our clients, our borrowers are buying anything as small as a single unit all the way up to a 20, 30 unit project. It could be a mixed use project. It could be a multifamily project. And they're buying them at a discount. They're buying them off market. They're buying them at foreclosure auctions. They're buying them in estate sales and what have you. And they're really full time real estate operators. Again, they're not a doctor who's trying to be a real estate investor. They are full time real estate operators. They don't have a W 2 job or anything to that effect. This is all they do. And
Hmm.
because they're able to essentially be full-time operators, they're able to find deals at a huge discount.
Hmm.
So when we're giving them financing, we're giving them a percentage of their purchase price. Mind you, that purchase price is already discounted off of the as is value of the property. So what that means is that we're just further secured on the basis of the loan because we're giving them a percentage of their discounted purchase price, which is discounted off the as is value. So we're giving them a percentage of that. What they do with the property then is they just reposition it, right? They can sometimes do a full gut renovation, they can do a conversion, they could do a vertical extension, horizontal extension, and so on. And then they ultimately either resell the property
Hmm.
or they refinance through either a DSCR product, a bank statement product, a P&L product. There's so many non-QM products that exist today that essentially enables the borrower to pay our loan off within that period of 12 months. So that's a term of the loan, but usually most of our loans are repaid within 8 to 11 months, which means that the exposure into the market, into the real estate space is very short-lived, which is another reason why a lot of our investors like to invest into our fund.
Awesome. So earlier you talked about, you mentioned that term bridge loans, and I want to come back to that just to, I think this is the perfect place to talk about that because someone may not know what that is. And so what you just talked about is really what a bridge loan is, right? Something to
Yep.
bridge the operator or like give them that short term so that they can fix it up and do some kind of refinance, right?
Exactly. Exactly.
Okay.
So we're providing that short-term capital for the acquisition and from time to time for the construction, right? So the question then becomes, well, Ruben, why wouldn't they go to Chase Bank? Why wouldn't they go to Wells Fargo? Why wouldn't they go to any other local, community
Hmm.
bank? And the answer is very simple. I mean, look, a lot of our operators, again, our borrowers, our clients, they're full-time real estate investors. They don't really have that W 2, right? They don't really have that type of income that a Chase Bank or a Wells Fargo bank would like. So that's one reason, right? Secondly, it could be that they just need to close really, really fast. Again, going back to that point of the fact that they're buying properties already, the purchase price is at a discount from the as is value. Well, the
Hmm.
reason why is because they're able to tell the sellers that, hey, we'll close your deal within a week, 2 weeks. We'll close within a week, 2 weeks. And that enables them to get a discount off the as is value because we close far quicker than, say, Chase Bank or what have you. Because guess what? By the time they underwrite the loan, Chase Bank, Wells Fargo, who have you, it takes them months to do so. Versus with us, within a couple of weeks, we could be at the closing table. Outside of that, it could be just an asset that's just not mortgageable, not because the asset is bad, but because there's fire damage, there's water damage. There could be some squatters or tenants in there that are just not willing to give access into the property until the property is closed. So there could be a number of reasons of why the borrowers are coming to us versus a local bank.
Yeah, and just to clarify, the things that you just talked about, the fire damage, water damage, et cetera, these are things that traditional lenders think is too high of a risk and they won't actually lend on. That's why, right?
Exactly, exactly. Or it's not mortgageable, right? They want to be able to see a property that is instantaneously accessible and livable. And some of the assets that we're financing, they're not livable, right? I mean, I've had properties where there was a missing roof, right, for
Mhm.
10 years or so on, right? I mean, everything is rotted. It's down to the studs, gut renovation. So it could be a number of reasons, but that is definitely one of the reasons.
So this, especially newer investors, they're might be hearing what you're saying and they're thinking, they might be asking, I thought that, if the banks and the traditional lenders are looking at, um, uh, you
This
know,
is a high risk, is what you're saying?
exactly,
Yeah,
exactly.
yeah, yeah.
So
Why would
how
we
are
want to do it?
exactly.
It's a very good question. So, you know, our thesis is very simple, and it's not something that we've created. I like to think that I'm a smart guy, but I in no way contribute to be a genius. There is a lot of Wall Street money that's been essentially pouring in to Main Street, which is our kind of space, right? The hard
Yes.
money private
Mhm.
lending space. And the main reason to that is because they understand that the existing supply, the real estate supply has and is aged, right? There is essentially, not enough supply of housing, right? So our borrowers today, they're not buying the properties to live in. They're buying the properties with the intent of adding value and then reselling that. So what we're essentially doing as private lenders is actually we're helping, communities, neighborhoods really improve the value of that neighborhood by repositioning some of the assets that have been, you know, you could say in bad positions, in really bad conditions for years and sometimes even decades.
Hmm.
So we're bringing value in a very indirect way by being able to improve the properties in or around the area. Now, again, we're not looking at the assets, and the borrower's not looking at the assets to live in the property. So we're not really looking at the borrower's ability to pay the loan on a monthly basis. What we're looking at is the borrower able to buy the property at, say, hypothetically speaking, 100,000, put $50,000 of renovations into it, and then resell it for $250,000? Do the comps in that area support a value of $250,000? But outside of that, are the people in that area, in that neighborhood, able to afford a property in that $250,000 range? So, for us, the thesis is they're buying a property at a very discounted price. They're adding value to the property, and the intent is to resell the property. Now, the question then becomes, well, Ruben, what happens if they can't resell the property? What happens
Hmm.
then? Like, how are you securing your investors then? The idea for us is that we stress test every single loan. We look at the loan from a perspective and a lens of if the borrower cannot resell the property or sometimes even chooses not to, right? Today, with all the non-QM, space and involvement of that space, a lot of our borrowers are choosing to keep the properties and they're just adding it to their portfolio and collecting rent roll, right? They're creating generational wealth. And the idea is if the property is not sold or the borrower chooses to keep the property, is the property able to produce enough income to support not only our mortgage, but then the future mortgage and the takeout loan? And that's really the 2 cents approach that we take on every single deal is, can the property be resold? Is there profit to be made if it's resold? And if not, is the property able to produce enough income?
Got it. So I might have missed it, but I just wanted to clarify in the event that it couldn't have been resold, but you mentioned something like a take loan. I'm trying to
Takeout loan,
understand
yeah.
if
Yeah.
the are you still able to get your the principal loan out within that 11 months that you were talking about?
Exactly, exactly. So our borrowers, they when they buy a property, usually takes them about, I would say, 3 to 4 months to renovate the property,
Hmm.
and then say another 3 months to either resell the property or to lease it out, and then ultimately, refinance the property. And when they're refinancing the property with, a local community bank, a non-QM lender, they're refinancing with the intent of repaying us plus taking out whatever equity they've put into those deals.
Perfect.
So, yes, they are repaying us in full. In fact, they wouldn't even be able to take out another loan without repaying us because we're always first lien mortgages recorded on the property, personally guaranteed by the borrowers.
Thank you for clarifying that part too.
Of course.
Um, so sounds great.
Yeah,
Listeners are probably
complicated.
thinking, has anything, really great to hear. I mean, those stats of almost $1 billion in loans, never
Yeah,
lost investors' cash.
yeah,
Bravo, absolutely, right? Always
appreciate
take
it.
bullets for your investors, definitely too. But just kind of curious. I mean, this also shows value to what you guys do and what and how you work with, your operators. Is there ever deals that have they gone bad? I mean, you talk about stress testing, but
Of course.
sometimes there are things that we can't possibly account for,
Oh, absolutely.
right?
Absolutely. And what we've learned is the I would say inexperienced novice investors who are just, they've been watching HGTV, right? And they just want to get into the world of real estate. They have full-time jobs. They're not really real estate operators. What we've learned is those are the guys that generally default on their mortgages, right?
Hmm.
They end up, coming across some kind of hiccup that they just can't get out of. And I think that, some of the defaults that we've had over the years are really revolved around the operators that are not experienced. So, if you look at our book of business today, our existing loan tape, I would say the bulk of our business, I would say 83% of our loans are with experienced operators who have done at least 2 or 3 flips in the past, similar to the one that we're financing for them, or even sometimes even 20, 30 flips in the
Hmm.
past, right? Guys that have already been around the block. I don't want to say we don't want to work with, novice investors, but we try to shy away from them from a perspective of, okay, look, you're going to come to me for financing. That's fine. I'll still give you financing, but I'm going to be at a very conservative leverage versus a real estate operator who is doing this on a full time basis. I'll give them a little bit more money. So, what we've learned is that the operators who are essentially novice have a higher likelihood of actually defaulting. But then
Hmm.
the question is, well, Ruben, how do you get out of that situation, right? How do you
Yeah.
actually make sure that, they either reperform or they, ultimately resell the property to be able to pay you back your loan?
Recoup the costs. Right.
Exactly, and protect the principal, right? The
Yep.
PP rule, right? Protect the principal. And the idea there is that, well, going back to that point of if you're a novice investor, I'm giving you very conservative leverage, which means
Mhm.
that now there's just a lot more equity built into the deals to kind of remind the borrower and the investor, hey, you have, 30% of equity, 40% of equity that's going to be wiped out if I take back the property, right? And if I do take back the property, I don't mind because I'm going to take back the property for 30, 60 cents on a dollar, 70 cents on a dollar. So I wouldn't mind taking back the property if that was the case. Generally speaking, once you remind them that they have a personal guarantee on the loan, we have a pledge of shares from them, we have a lot of equity built into the deal, they usually reperform fairly quickly.
Yeah. Yeah. Definitely. What is pledge of shares?
So what that basically means is that in the event of a default, we have the ability to take back the property by taking over the entity
Okay.
versus having to go through the entire judicial process of foreclosing on the property.
Got it. So pledge of shares, they've pledged their shares, so it's takeover
In the
rights.
entity. Exactly, because remember, we only lend to entities. We never lend to a person
Got it.
directly,
Got it.
right? There's the principals behind the entity, the
Yep.
members of the entity, they will personally guarantee the loans,
Got it.
but we're always lending directly to an entity, and that entity would effectively pledge their shares over to us.
Cool. Awesome. So that gives a much clarity on the entire model in general. And I love one of the things you talked about. This comes up a bunch too with it comes up more it has come up a handful of times, let me put it that way, about how, the people you work with are really helping to make the neighborhoods better, right? And I think what's particularly cool about this, especially when I was learning about things like government and taxes, that, the government wants to give, work with you as, a company because they're your silent partner, right? And you helping, be a company working with these operators indirectly, but helping to improve the neighborhoods too, right? So that's
Exactly.
impact, right?
Exactly. I mean, look, we if you look at some parts of New York, some pockets of New York, we'll start with the Bronx. We'll start with East New York, Brooklyn, right? We'll start with Bushwick. Those areas have changed to a point of, it being unrecognizable, right?
Mm,
From a perspective of, the values of the real estate have appreciated tremendously, right? And those who still own real estate there, whether they've been there for 5 years or 30 years or, 80 years, have definitely taken advantage of that. But most importantly, the city has as well. And the reason why is because as the values of the properties appreciate, so do the
taxes.
taxes, right? So
Yeah,
we now have the ability to spend more on education. We have the ability to now spend more on public safety, right? There's so many advantages and advantages that come with having to appreciate the values of the neighborhood that we really can't bypass or miss that point.
yeah, yeah, and yeah. I'll just emphasize the impact portion of it. I've been to places just like Detroit as well, and knowing flippers and people out there improving things is something noteworthy to mention. But let's move on. I think it was as earlier this week as well. We're recording this on Thursday, so I think it was like a Monday or so for me. I was talking to one of my colleagues, good friend of mine at this point. Um, just talking about investing for cash flow or net worth. Now you're talking about passive investing. Getting cash flow 45 to 55 around their days. I
45
forget
to
the
50 days, yeah,
there you go.
give or
45 to
take.
50 is what you said. And I think there's this idea of cash flow versus net worth, right? So I'd love to get your take on this. People are investing with you for passive income, for cash flow, but there's also some thinking here about growing net worth through passive real estate investing as well. Can you give
Correct.
me your thoughts about this at like a top level, between the two, and what investors come to you for? Let's start there.
Yeah, so it's so funny. I was actually having a conversation about this with a friend of mine last night. And the idea was, well, Ruben, I want to deploy some money with you. And I'm like, okay, great. I don't mind taking the money, right? But what's the plan? What are you looking to do? He's like, well, I want to leave something for my kids in the future. And I said, well, in that case, you got to go buy real estate. You don't invest with me. You invest with me if you need cash flow, right? You invest with me because you can't really buy or find the real estate. But he has a very successful business. He does really well for himself, and he has the ability to take time off if he needs to, right, or if he wants to. I mean, he could probably retire today if he would like. And I told him, look, because you have that ability to take time off, you should go out and buy real estate and have the time to manage it. You have the time to actually work actively.
Hmm.
And his whole thing was, Ruben, what's the purpose? And I said, well, one, you have something to leave for your kids. And two, with owning real estate, even, from time to time, especially in New York, right? Some of the real estate that you own, it may not be cash flowing, right? Especially because of the laws, landlord tenant laws here in New York. It's not favored or skewed in the favor of a landlord or an investor, regardless of how big or small you are, right? Which is totally unfair, in my opinion. It's really skewed in the tenant's favor. I mean, there are tenants that can stay in your apartment, in your unit for years without paying a penny in rent. And in fact, during those times, you actually still have to pay and fix their microwaves and their kitchens and the whole nine, right? I mean, it's so unfair. But nevertheless, I said, look, you buy real estate, you hold on to it. And he said, well, what if the tenants don't pay? I said, that's fine, because every 5 years, you have the ability to refinance that property and cash out money. That's tax free, right?
Hmm.
In being a private lender, I don't have those advantages, unfortunately, right? I don't have something that I can pass on to the children except for the goodwill of the company that I've created, right?
Sure.
Alongside my partners. So I think that, for a lot of investors, if they're not looking for a cash flow, but they're looking for something to leave for their investors, to their children, then investing into real estate, owning real estate is really the best way to go.
All right. So you're saying that if someone wants to do the generational wealth, then owning real estate is what it is. But if they don't and they want more cash flow, then passive investing is where it's at.
It depends again on what their intent is and what their ability to do is, right? I mean, look, in New York specifically, like I said, it's hard to cash flow a property
Yep.
unless your debt is very low leveraged, right? You have very low leverage debt, and you have good paying tenants, right? The problem is that if a tenant chooses not to pay you in New York, you have no choice but to ride that storm until they vacate. So it really depends on your timing, your availability, and your future and long term or short term goals.
Got it. And if you have the time to allocate and want to make the time to do it too.
Exactly.
All
Exactly.
right. So is the one of the things I see often is, and myself included, I was excited about real estate, investing in real estate. I had done some limited partnerships for myself too, and I had invested in some development and multifamily value add, and I wasn't getting cash for a while, right? So
But you
you
got
know
depreciation.
I did. That is
Yeah.
true. um, but the idea of, and I just want to emphasize here, let's talk about the cash flow portion here, because if you're, doctors or lawyers or tech, they're making good W-2 money, right? And but they're getting that cash flow to with what, to supplement or to ultimately try and replace income. Which one is it?
It really depends, right? I mean, there's some people who just love what they do day in, day out. They're not looking to replace that in any capacity. But I think a lot of investors who are investing into real estate, their whole long-term goal is to replace any existing jobs that they ultimately have. And I think it's the right thing to do, right? Is to be able to figure out a way to cash flow on a monthly basis to be able to replace any existing job that you have so that you don't have to work as hard as we do today. Because look, we have the capacity to do it today. We're young, but what's going to
Hmm.
happen when we're in our 70s or 80s or what have you? It gets a little harder. It's harder for me already. I mean, compared to what it was like 20 years, 20 years ago. I mean, it's can't work the
Yeah.
same hours as I used to.
Yeah, yeah, more demands on things for sure. And so is the play then to make money earn your money, get the cash flow, and then just reinvest so that you can continue to get that um, critical mass of capital to continue to build, 100, just as an example, 100,000 invested today at the double, lower double digits, and then have that continue to compound over time? Is that the
Absolutely.
plan?
Because look, I mean, at the end of the day, your asset that you buy today at a very low cost, as an example, you have the ability to add value to that asset, right? Whether it's construction, renovation, extensions, or what have you, or just bringing in tenants that are going to be paying you high dollar, right? Because some of the landlords existingly today, they may not have a focus to reposition the assets, right? They just want to be able to be a passive investor, but they don't really understand what that truly means.
Hmm.
So if you have the ability to add value to those properties and then ultimately refinance those properties and cash out the new value that you've created, well, guess what? Now you have more money to work with every single 2 to 5 years that you didn't have before. And if you use that money and roll it back into real estate investing and buying more real estate, then I think it just brings a lot more value than you think.
And so taking that now analogy from the passive investor side, it's making money on what they've invested, getting that
Originally,
monthly cash flow and keep on adding it is what you're saying.
exactly, exactly.
Okay. 'Cause you're giving it an active, example, and I just wanted
Example,
to
yeah.
make sure that was super clear for, the passive investor. And so, um, what I wanted to take that to was really from an asset allocation perspective, because, I can't speak for, the doctors or lawyers, but I can talk about this from a tech professional perspective. And we've all heard of golden handcuffs, right? We have our restricted stock units and so
Right.
forth, and hundreds of thousands of cash or stocks wise from there. But that's most of the tech stocks are not giving dividends. And if they are, they're not giving lower double digit returns.
Right.
So allocating, this, I'm going to ask you a question. And I know this, prefacing this isn't legal, this isn't, financial and all that advice, but, is it a good idea, or what's the thinking around cashing out some tech stocks or stocks that are had and allocating to something that gives you that monthly cash flow?
It's a very good question. I mean, look, I guess it really depends on what kind of stock you're investing into, right? Or you're what where you're working today. I think there's a lot of value in some AI stocks, right, and some AI companies today. I think that the value may be very long term kind of
Hmm.
vision. And when I say long term, I mean anywhere between 2 to 5 or maybe 10 years at most. The question then becomes, how certain and confident are you in the product that you're creating where you have the golden handcuffs on, right?
Hmm.
If you're confident in, the ability of the company to grow to newer heights and newer levels that you probably wouldn't be able to develop in, your real estate career or the other passive careers that you're looking to invest into, then you might as well, keep it there. But then the question comes is, well, do you believe in the power of diversification, right? Do you ever want to have your eggs in just one basket? And I think a lot of investors would probably choose to say, no, we don't want to be, having all our eggs in one basket. We want to be diversified. Well, in that case, I think maybe it would make sense for them to maybe cash out on some of their stocks today and be able to reinvest into other assets or other cash flowing businesses.
Yeah,
I
definitely. Because I
I guess it
mean,
all comes down to, like, the goals, right? And the confidence in what you're doing.
yeah, certainly. So I just think about, there are some of the Nvidias and et cetera, right, that are definitely in the news, but there's also tons of other companies that are coming up that maybe aren't the ones you want to, may not be around. And so,
For long, right.
yeah, exactly. And I'm not making any claims or any specifics there, but it's just the thinking on the diversification, what you were talking about. So one of the questions I get is, well, how much do you actually have to invest? What does that actually look like? Depending on the roles that people are in their tech roles, they're going to get, well, like everyone, right? There's going to be multiple vestings throughout the year, and so that can vary from 25, 50, 75K, vesting per vest through the year.
Mhm. Per year, yeah.
But just, for, let's say, for your fund as an example, or this fund, What is it? What are minimums to invest in?
Yeah, so our minimum investment today is 250,000. Our average investment, I believe, is anywhere between six to 800,000. We essentially have three classes of shares: $250,000 investment, a $500,000 investment, and a $1.5 million investment. And every class has its own preferred return,
Mhm.
its own asset management fee. In fact, the $1.5 million investment does not even have an asset management fee. We kind of waive a lot of the fees, and we take a much smaller promote. And it obviously has its own kind of carry. But our investors today, between all three classes, are earning anywhere between 13 to about 16.5% on an annualized basis. In fact, 2025, we're projected to hit anywhere between 13 to 16.5, 17% on annualized basis. So I think that it all really kind of again goes down to and comes down to like what is their goal,
Mhm.
whether it's short term or long term goal.
For those, tranches, for those classes, is there someone listening might be like, "Well, I don't know if I wanna do 250 out the gate on the first one,"
Right.
right? And
Right. Right.
so, talking about this, there's, some things that are important to talk about, right? Do you accept, the ability to combine, like assuming someone out there has, like, an HSA or an SDIRA or something like that, can they combine cash with one of those things?
Oh, yeah. Yeah, so we look at it from more like a holistic point of view, right? We have some investors who have invested through their personal name, through their self-directed IRA, and another entity or business that they own. So they
Mhm.
essentially kind of have like three vehicles of investment. And yeah, we combine all that and we give them that ability to say, okay, well now combined you're at 1.5 million. We'll give you that class of share that you hit at 1.5 million. So we have that discretion to be able to do that.
Super cool. So if someone's listening and they have one or two friends that want to come up with their own entity to invest in, right? They could come up to all three of them as an example, and they could pool their cash to 250, and they could invest it as one investment from your perspective.
Exactly. So we actually
Okay.
have a group that's done just that. They created a vehicle and they invested into our vehicle. So it kind of comes almost like a fund to fund investment, you can say.
hmm
But yes, the answer is they have the ability to do that, and we have the flexibility to accept those investments.
Are you seeing, and what are you seeing? Just kind of pivoting here. Uh, are you seeing that happen more and more as people are doing like multiple people are coming together to pool their capital to invest with you?
Not necessarily. I mean, look, I think if an investor has another friend that wants to, invest alongside them, it becomes complicated because, sometimes one investor could be at 100,000, the other one is at 150,000, right?
hmm
And then having to, portion out the taxes that are owed and due, and it's sometimes more of a brain damage for them, not for me, but for them. Then, as a result, they just choose not to go that route. I think it really depends on how well you know the person,
Oh yeah.
how comfortable you are with that person, how much you trust that person, because that person will have the rights the same as you do
hmm
in that vehicle. So it's more of like a situational kind of a decision than anything else.
I'm kind of curious what you were talking about. Just name things off top of your head about the brain damage that happens
Yeah.
for them. I have a fund to fund that I do, and I raise some capital for. So I'm particularly interested for you to mention what some of that brain damage is for people to go
Well,
do this on their own.
really, it's their taxes, right? How do we apportion that? It's the cost of actually owning and operating that entity, right? But also kind of divvying up the monthly distributions. I mean, some people try to complicate things, right? And I'm like, well, look, you're 75% of the capital, he's 25% of the capital. Just distribute it 75-25. I mean, it's that simple. And it sometimes gets complicated. One says, well, I put my money in on this time of the month, and he put his money in on that time of the. Don't complicate it. Just make it simple. Move on. It's not worth the brain damage.
Yeah, super cool,
Seems
man.
like you kind of went through the same thing.
Yes. So, all right, let's close that one out. I know we're coming up on the time we have you here for. I super appreciate it. Just quickly, what are anything you're seeing, any trends that you are seeing, up and coming, people should just kind of be aware of, or you're paying attention to out there?
So look, I think a lot of real estate investors are being a bit cautious into where they want to put their money, whether they want to buy any more deals, right? I think the crackdown on immigration has been a little bit of a heartfelt situation for real estate because we depend on labor, right? And if that labor does not exist anymore, it's hard to finish the projects. It's hard to finish the projects within budget, especially when tariffs are right around the corner, right? The unknown. I think, also the uncertainty between, our president, along with, the Feds is also something that a lot of our investors are being cautious in deploying their money into deals that may be long term. And I
Hmm.
think that what we're starting to notice is that investors' appetite and sentiment is now more on short term lived investments versus long lived investments, right? They don't want to invest into something that could be, a 10-year hold or period, or 5-year hold or period. They want to put their money into something that is very short lived and they're able to redeem it much sooner than what's usually kind of put out there.
Got it. I forgot to ask, and I have to ask, is for doing is there any depreciation or anything as part of the fund?
Unfortunately, there isn't. Only because we're not operators or owners of real estate. We are the lenders on real estate. The depreciation only is applied to the equity holders of that real estate.
Got it. But 45 to 50 days turnaround on getting monthly
Cash flow.
cash is still outstanding.
And it's truly passive, right? I mean, it's
Yeah.
true definition of passive cash flow.
Awesome. Ruben, thanks so much for being here. Where can people find
Steve,
you? How
thank
can
you
they
so
connect
much.
with you?
Yeah, they can find me on all social media platforms. Our company handle is WeLend LLC. They could also email me at ruben@welendllc.com.
Outstanding. I will make sure that is in show notes, sir.
You're the best.
Ruben Izgelov, thank you so much.
Thanks, Steven. Appreciate it, man.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.